If you follow this system for just 2 years, staying broke becomes almost impossible. Not because of motivation, not because you suddenly work harder, but because the math starts working in your favor. Most people don't have an income problem, they have a structure problem. Here's what almost nobody tells you. Your salary is designed to keep you functional, not free. You can make 6 figures in America and still feel pressure every single month. Still wait for payday. Still check your balance before swiping your card. That's not a personal failure, it's structural. The system rewards ownership, not effort. Look at any list of wealthy individuals. You won't find longest hours worked. You'll find founders, shareholders, investors, landlords, people who own assets that generate value whether they're awake or asleep. Peter doesn't become wealthy because someone pays him well. Peter becomes wealthy when he owns something that pays him. Income is what you trade your time for. Wealth is what works without you. If your next bill depends on your next paycheck, you're not building wealth. You're renting your life from your employer. The real shift happens when you stop asking, how can I earn more, and start asking, what do I own? Because until you own something, something owns you. Your rent, your car payment, your credit card balance, that's the invisible chain most people never break. And here's the uncomfortable truth. Discipline alone won't save you. Not long term. Every day you're forced to choose between spending and saving, comfort and investing, now and later. Decision fatigue is real. Eventually, emotion wins. Systems win because they remove emotion from the equation. The wealthiest people aren't more motivated than you. They just decide once and automate the rest. If you're serious about building assets instead of just collecting paychecks, hit the like button and subscribe. This channel is about structure, not hype. About ownership, not appearances. Now, here's the framework that makes the upward curve real. 20% goes to growth. 10% goes to stability. 60% covers true essentials. 10% is for enjoyment. Simple, scalable, ruthlessly effective. 20% is your ownership engine. Investments, skills, assets that multiply. This is what transforms a flat financial life into exponential growth. 10% is your protection layer, an emergency buffer. Because one unexpected expense should never destroy years of progress. 60% covers real living costs, not inflated lifestyle upgrades disguised as needs. And 10%, that's sustainability. Guilt-free spending so the system doesn't feel like punishment. This works at $2,000 a month. It works at $10,000 a month. The percentages scale. The structure stays. Most people invert this. They spend first, save what's left, and invest eventually. But eventually never shows up. In this system, you pay your future first. The moment income hits your account, money moves automatically. Before you see it. Before you mentally spend it. Before lifestyle inflation expands to consume it. Because here's a psychological reality. Spending grows to match available income. So, remove availability. Automation is more powerful than willpower. Time beats amount. Every single time. A 25-year-old investing $500 a month for 10 years, then stopping, can end up with more at retirement than someone who waits until 35 and invests the same amount for 30 years. That's compounding. Early structure beats late intensity. Starting small today is stronger than waiting to start big tomorrow. And that 20% doesn't begin with risky speculation or chasing trending stocks. It begins with foundation, high-yield savings, government bonds, capital preservation, liquidity, stability. Boring is powerful when you're building base layers. Because the first phase of wealth isn't explosive growth, it's control. Once your foundation is stable, the growth engine expands. The core of that 20% for most people should be broad market exposure. Index funds, ETFs. Not because they're exciting, but because they're efficient. When Peter buys a broad index fund, he isn't betting on one CEO, one product, or one trend. He's buying the productive power of the entire market. You're not trying to outsmart Wall Street, you're trying to participate in it. Over long periods, broad U.S. market indexes have averaged strong annual returns. Not every year. Not in a straight line, but over time consistently upward. And consistency compounds. Trying to beat the market is ego. Matching the market for decades is strategy. But here's where most people underestimate the game. the highest return investment you'll ever make probably won't be a stock. It's you. High income skills are wealth accelerators, copywriting, sales, coding, marketing, video editing, AI implementation, skills that increase your economic leverage. If Peter invests $2,000 into learning a skill that increases his income by $20,000 per year, that's not a 10% return. That's a 10 times return in year one. No ETF can reliably compete with that kind of acceleration. Assets grow money, skills grow earning power, and earning power feeds assets. Then there's real estate exposure. Not necessarily buying rental properties immediately, but gaining access through REITs. Real estate investment trusts allow you to own diversified property portfolios with the price of a single share. You get dividend income, you get exposure to appreciation without managing tenants or fixing toilets. It's ownership without operational stress. After that come individual stocks, but not speculation, not day trading, not chasing hype cycles. Ownership in durable companies you understand, businesses you believe will still exist in 20 years, utilities, consumer staples, healthcare, infrastructure, diversified across sectors. Wealth is built through time in the market, not timing the market. For those with higher risk tolerance and strong foundations, scalable income streams create asymmetric upside. Digital products, service businesses, content, software. Income not directly tied to hours worked. But this only works if the base layers are solid. Never build volatility on top of instability. And then come alternative assets. Bitcoin, gold, collectibles, high volatility, high knowledge requirement. If you cannot clearly explain why something has value and what drives its demand, you are not investing. You are speculating. Speculation feels exciting. Ownership feels boring. Boring builds wealth. Now here's where most people fail. They understand the strategy, but they don't execute it. Execution is not about intelligence, it's about removing friction. Automation beats intention. The day your income hits your account, transfers should trigger automatically. Not when you remember, not when you feel motivated immediately. But transferring money is not investing. Cash sitting idle in a brokerage account earns nothing. The automation must continue one step further. Income arrives, money moves, assets are purchased. Automatic contribution, automatic allocation, automatic execution. This removes hesitation, removes fear, removes procrastination, and then you focus on the real multiplier. Increasing income. Wealthy individuals don't obsess over cutting one coffee. They obsess over increasing earning power by 20%, 50%, even 100% over time. Negotiate raises, switch industries if necessary, build side income, stack skills, scale contributions. A disciplined structure on $4,000 a month builds progress. The same structure on $8,000 a month builds acceleration. The system stays the same. The inputs expand. Most people believe they have a money problem. They don't. They have a stability problem. One unexpected car repair becomes a credit card balance. One medical bill erases 6 months of savings. One emergency forces them to sell investments at the worst possible moment. That's what the first 10% protects against. It's not designed to grow aggressively. It's designed to absorb impact. When markets drop 30% and you need $3,000, you don't liquidate growth assets at a loss. You pull from stability. You preserve compounding. That buffer is what keeps the upward curve intact. To calculate it, start simple. Add up your essential monthly expenses. Housing, utilities, food, insurance, minimum debt payments, transportation. Only the true necessities. Housing, utilities, groceries, insurance, minimum debt payments, add those up. That's your essential number. Now multiply it by 5 or 6. That's your stability target. If Peter spends $2,500 per month on true essentials, his buffer isn't random. It's between $12,500 and $15,000. Not invested in volatile assets, not chasing yield. Parked somewhere liquid, stable, accessible. High-yield savings accounts, money market funds. Places where the goal isn't growth, it's protection. A modest return is a bonus. Accessibility is the priority. This fund is not designed to impress anyone, it's designed to absorb impact. And building it takes time. That's fine. Automation handles patience. Even $100 or $200 a month compounds into stability. The key rule is simple. If you touch it, you rebuild it immediately. Treat it like a personal loan that must be repaid before anything else. Because this fund won't make Peter rich, it will make him resilient. And resilience keeps the upward curve intact when life inevitably happens. Now here's where most people quietly sabotage themselves. They get a raise and upgrade their lifestyle the same month. Better apartment, new car, nicer subscriptions. Income rises, expenses rise, and stress remains exactly the same. That's lifestyle inflation. The silent wealth killer. Looking wealthy and being wealthy are opposites. One is about signaling, the other is about options. The person driving a luxury car with $400 in savings isn't winning. They're performing. And performance is expensive. This is where the 60% rule becomes powerful. It forces clarity. What are true essentials? Housing, food, transportation, utilities, insurance. That's it. Everything else is optional, even if culture tries to convince you it's not. Living below your means isn't deprivation, it's leverage. When Peter caps essentials at 60%, he's forced to ask better questions. Do I need a bigger apartment, or do I want validation? Do I need a new car, or do I want approval? That shift changes everything. Housing and transportation are the two largest fixed cost traps in America. People stretch to the maximum mortgage they qualify for, then wonder why they can't invest. They sign 6-year car loans because the monthly payment fits, without calculating the long-term opportunity cost. Let's run simple math. If Peter earns $5,000 a month, his essential cap is $3,000. If rent is $1,800 and a car payment is $500, he's already at $2,300 before groceries, utilities, and insurance. He's operating at the edge. There's no room for growth. He's not building assets. He's servicing lifestyle debt. Now consider alternatives. Downsize strategically. A slightly smaller place in the same neighborhood can free hundreds per month. Less space often means less consumption. Transportation? A reliable used vehicle can last a decade. A modest car paid in cash may not impress neighbors, but it builds options. A financed $40,000 SUV might look powerful, but over time, interest and depreciation quietly drain wealth. Fixed costs compound negatively. A $400 monthly car payment over 10 years equals $48,000 out of pocket. If that same $400 were invested consistently at a reasonable long-term return, it doesn't just stay $48,000. It grows. That $400 per month doesn't just disappear. Over time, invested consistently, it can turn into roughly $73,000. So you're not choosing between a nice car and a boring car. You're choosing between a car and optionality. And optionality is freedom. This is where systems beat willpower again. Because nobody wakes up excited to deny themselves things forever. That's not realistic. So instead of relying on discipline, build rules. Simple ones. Wait 48 hours before any non-essential purchase over $100. If you still want it after 2 days, it's probably intentional. If not, it was impulse. Use cash or a separate debit account for discretionary spending. It hurts a little more to see money leave physically. That friction protects you. Create a personal purchasing filter. Peter only buys something if he's wanted it for 30 days and it replaces something he already owns. That one rule alone eliminates most emotional spending. The goal isn't to live like you're broke when you're not. It's to live like someone who understands that every dollar spent on ego is a dollar stolen from freedom. But here's the trap on the other side. Cut too aggressively and you'll eventually rebel. Extreme restriction doesn't create wealth. It creates burnout. And burnout leads to binge spending. That's exactly why the final 10% exists. It's not a reward. It's structural sustainability. This is your enjoyment fund. Ideally, in a separate account, psychologically distinct from investing, from bills, from savings. It's a percentage, not a fixed dollar amount. So as income grows, your lifestyle grows responsibly with it. You spend it however you want. Travel, experiences, hobbies, dinners. No guilt, no justification. But here's the nuance. Experiences outlast objects. A new gadget gives you dopamine for a week. A weekend trip gives you a story for years. A dinner with people you care about strengthens relationships. A flashy purchase just collects dust. When enjoyment is intentional, you stop overcompensating with random spending. You actually spend less overall because you're choosing consciously. Now step back and look at the full structure. 20% compounding into ownership, 10% protecting your downside, 60% controlled and intentional, 10% keeping life enjoyable. Growth, stability, control, sustainability. Peter's income increases over time because his skills improve. His assets appreciate quietly in the background. His emergency fund absorbs shocks. His lifestyle remains below his capacity. Momentum builds without constant effort. When a laptop breaks, it's an inconvenience, not a crisis. When markets drop, investments stay untouched. When opportunities appear, capital is available. That's what real wealth feels like. Calm, quiet, flexible. No need to prove anything. No finance status symbols, no stress behind the scenes. Wealth isn't about looking successful. It's about having options. The option to say no. The option to take a calculated risk. The option to work because you want to, not because you're cornered. And this doesn't happen overnight. It's not dramatic, it's not flashy, it's inevitable. If the structure runs daily, follow it consistently, automate it, increase income over time. Protect your downside, invest early, spend intentionally, do that for 2 years, and the upward curve stops being theoretical. It becomes visible. If this changed the way you see money, hit the like button. It really supports the channel. And if you're ready to make decisions that actually compound, subscribe for more videos like this. Build assets, build options. I'll see you in the next one.